Warren Buffett, the Oracle of Omaha, is a legendary investor known for his simple yet powerful approach to building wealth. Invest consistently in the S&P 500, a collection of America's top companies, and watch your money grow over time. This approach has turned ordinary people into millionaires. With patience and discipline, you can transform a modest investment into a life-changing sum. Buffett's philosophy centers around long-term thinking and ignoring short-term market fluctuations. He believes in the power of American businesses to generate profits over the long haul. His strategy emphasizes buying great companies and holding them for years. One of Buffett's famous quotes, "Our favorite holding period is forever." This underscores his belief in the power of compounding. By resisting the urge to buy and sell frequently, you allow your returns to compound over time. Remember, investing is a marathon, not a sprint. Follow Buffett's strategy to achieve financial freedom and turn your dreams into reality. Warren Buffett's journey to becoming one of the world's wealthiest individuals began with a simple lesson in patience. At just 11 years old, he purchased his first stock, 6 shares of Citi Service Preferred. He eagerly watched his investment grow, only to be disappointed when it dropped shortly after. Determined to recoup his losses, he sold his shares as soon as they reached a small profit. However, Buffett's initial excitement soon turned into a valuable lesson. The company's stock price soared in the following years, teaching him the importance of patience and long-term thinking in investing. Had he held on to those shares, his initial investment would have multiplied significantly. This experience solidified his belief in the power of long-term investing and the need to ignore short-term market fluctuations. Buffett's story highlights a crucial principle in investing: the power of compounding. Compounding is the process by which your earnings generate even more earnings over time. It's like a snowball rolling down a hill, gathering more snow and momentum as it goes. The longer you allow your investments to compound, the more significant your returns will be. This principle applies not only to stock market investments, but also to other aspects of finance. By understanding and harnessing the power of compounding, you can accelerate your journey to financial freedom. When it comes to investing, many people are drawn to the allure of gold. It's seen as a safe haven asset, a hedge against inflation, and a store of value. However, a closer look at historical data reveals a different story. One where stocks, particularly those represented by the S&P 500, have consistently outperformed gold over the long run. Since 1928, the S&P 500 has delivered an average annual return of around 10%, while gold has averaged about 5%. This significant difference in returns highlights the superior growth potential of stocks over the long term. While gold may offer a sense of security during uncertain times, its returns have paled in comparison to the robust growth of the stock market. Investing in the S&P 500 provides exposure to a diversified portfolio of America's leading companies, allowing you to participate in their growth and innovation. This broad exposure helps mitigate risk while capturing the upward trajectory of the American economy. While past performance is not necessarily indicative of future results, the historical data paints a compelling picture. By choosing stocks over gold, investors have historically positioned themselves to benefit from the long-term growth potential of the stock market. One of Warren Buffett's most valuable insights is his emphasis on ignoring market noise. The financial world is awash in a constant stream of news, analysis, and opinions, often creating fear and uncertainty among investors. Buffett, however, advocates for a different approach. Tune out the noise and focus on the fundamentals. He understands that short-term market fluctuations are inevitable and often driven by emotions rather than logic. Instead of reacting to every market dip or surge, he advises investors to maintain a long-term perspective. Remember that you're investing in companies, not just stock prices. Focus on the underlying businesses you're invested in and their long-term growth potential. By tuning out the noise, you can make rational investment decisions based on sound principles rather than being swayed by temporary market swings. Remember, investing is a marathon, not a sprint. By staying focused on the long term and ignoring the daily market noise, you can weather the inevitable storms and come out ahead in the end.